Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. Inflation. The last mile could be the hardest. Even though I've never come anywhere close to running a marathon of any sorts, I'm told the last mile could be the most difficult part of the endeavor. And looking at how inflation has performed to begin 2024, it appears the improvement investors have witnessed over the first 25 miles of this marathon could have been the easy part. And the road to mile number 26 may not be that easy. Now, the money and bond markets may have gotten a little complacent on inflation trends after the 2023 experience. The peak readings that we saw in 2022 for both headline and core inflation were put in the rearview mirror rather quickly, right? As price pressures cooled off on an almost monthly basis last year. And I think given the rally in the Treasury market that we saw in Q4 of last year, there's little doubt that this type of improvement was expected to continue and perhaps leading the Fed to achieve their 2% threshold in the process. Now, for this podcast, I just wanted to focus exclusively on inflation minus food and energy, utilizing the two different gauges, the Consumer Price Index and the Personal Consumption Expenditures Price Index. So CPI, PCE. Now, interestingly, one could argue the markets focus more on CPI, while the Fed uses the PCE measure for its official inflation target. And what we've seen is that both core inflation readings did reverse course last year, but the degree of improvement has leveled off somewhat. Now, core CPI and PCE, they each hit their peak year-over-year gains of 6.6%, 5.5% respectively in September of 2022, and then they dropped to about 4% to 3% towards the end of last year. But that pace of improvement has become a bit more grudging over the last 2 to 3 months. Core CPI, 3.8%, not too far removed from 4, right? Core PCE at 2.8% in February, not too far removed from 3%. And that's the latest numbers that we do have available. And, given this backdrop, what's a central banker to do? Looking at recent comments from Fed Chairman Powell and Governor Waller, one gets the consistent message that the voting members are not in a hurry to cut rates, but that rate cuts will more than likely occur this year. However, there seems to be some daylight between these two policymakers' views on when and by how much. Now, Powell doesn't seem to be overly deterred by the recent inflation readings, but Waller did say the data is leading him to believe that, quote, it is appropriate to reduce the overall number of rate cuts or push them further into the future. Powell's also recently mentioned that perhaps inflation doesn't need to get down precisely to the Fed's 2% target. Now, does that mean that core PCE at 2.5% would be viewed as acceptable to begin cutting rates? If you look at the history between core CPI and core PCE, there is usually a spread between their year-over-year readings, with the post-COVID period of December 2020 to December 2021 really being the only exception over the last 10 years. So if this spread holds, would the Fed feel comfortable lowering rates if core CPI was somewhere between 3 to 3.5%? And while the Fed may look to begin easing in such a scenario, the Treasury market may not be all that thrilled, especially if the labor market data remains solid and resilient. So I'm going to end it there. I hope you all have a great rest of the week and be well.